Welcome to the new Revenue Recognition Guidance webinar on disclosures for private companies. My name is David Fonts. I'm a partner with BlumShapiro, and today I'll be going through disclosures as part of our continuing series on the new Revenue Recognition Guidance for private companies. Adoption dates for most non-public companies required for reporting periods in 2019. With 2019 right around the corner, disclosures are one of the areas of particular importance, and we would like to go through this in a bit more detail here today. Here's today's agenda. First, we'll start off with an overview of the effective date and types of financial statements that are impacted by the new revenue recognition standard for private companies. Then we'll get into the actual required disclosures for non-public entities, which can be categorized in three areas: disaggregation of revenue, contract with customers, and performance obligations. And finally, we'll conclude with the resources available from BlumShapiro. So, when do private companies have to implement this standard? For private companies, the standard is effective for annual and interim periods beginning after December 15, 2018, which is essentially 2019. The standard is already effective for public companies, which it became effective at the start of the year, effectively January 1st, 2018. The next question is, who does it impact? So, it impacts any type of U.S. GAAP-based financial statement, regardless of the level of service, whether it's an audited financial statement, a reviewed financial statement, or a compiled financial statement. This standard applies. Reporting periods does not matter. As long as it's a reporting period in 2019, it could be an annual financial statement, it can be a quarterly, it can be a monthly, a semi-annually. All reporting periods are included under the standard. But there are some revenue streams which are excluded from the standard that this guidance does not apply to. These revenue streams include lease contracts, insurance contracts, financial contracts, guarantees, investment income revenue streams, contribution and collaborative agreements, and non-reciprocal grants and contracts. The existing GAAP guidance will cover these revenue streams. So for private companies, the first required disclosure for private companies is a disaggregation of revenue. Under the standard, revenue is required to be disaggregated according to the timing of the transfer of good or service and the qualitative information about how the economic factors affect the nature, amount, timing, and uncertainty of revenue and cash flows. Let's take a look at an example of what a disaggregated revenue disclosure will look like in a set of financial statements. This example comes straight from the guidance. Under this example, the guidance gives you multiple ways of how you can present or break out the disaggregation of revenue in a set of financial statements. Under this example, it gives three examples. The first example shows a breakout by primary geographic markets. It shows a breakout between North America, Europe, and Asia. So that's one way the guidance gives as an option to present disaggregation of revenue. Another way the guidance gives is by major good or service line. Under this example, it shows the major goods or service line that this company has. The final example which it gives you is the timing of revenue recognition. So under the third scenario, it shows revenue recognized over a point of time, underlying goods transferred at a point of time. Then the second piece is the service transferred over time. So it shows over time versus a point of time. So these are three ways that the guidance shows that you can present the disaggregation of revenue. But ultimately, it's up to management to determine what the best way to break out that information is for the use of the financial statement. So it's up to management to provide the most useful measure of a breakout of revenue that would be most useful to the financial statement user. The next required disclosure for private companies are contract balances. Under the standard, the private company is required to disclose the opening and closing balance of receivables, contract assets, and contract liabilities, if it's not otherwise separately presented in the financial statements. So let's take a look at what a contract balance disclosure will look like in a set of financial statements. As you can see, this is a very simple disclosure. For the most part, this information may be included elsewhere in the set of financial statements, but here's a simple breakout where we show the beginning balance of an accounts receivable account, the contract asset account, and the contract liability account. Then you show the corresponding ending balance. So this is a very straightforward example. For the most part, this information may be included in a balance sheet. It may be included in other areas of the financial statement. If that's the case, a separate disclosure is not required. But if that information is not included elsewhere in the financial statement, a separate disclosure will be required. The final required disclosure for private companies relating relates to performance obligations. Under the standard, a private company is required to disclose when the performance obligation is satisfied. Is it upon shipment? Is it upon delivery? Is it as the service is rendered, or is it upon completion of the service? Next is payment terms. When is the payment typically due? Is it variable? Is it a fixed payment? Is there a financing component with regards to the payment terms associated with the performance obligation? Next is the nature of good or service that you're going to ultimately deliver to your customer, followed by any obligations. Is there any returns associated with the performance obligations? Is there any refunds? And generally the rights of returns around a performance obligation. And finally, the types of warranties associated with the performance obligation is required to be disclosed. So let's look at an example of what this disclosure will look like. So here's an example that would be included under the summary of significant accounting policies. So this example shows really when the performance obligation is satisfied. It goes over the payment terms associated with the performance obligation. Then it speaks to the nature of goods or services that are being delivered and the obligations for returns. I won't read this example. However, the slides will be available for download on the BlumShapiro Revenue Recognition Resource website. This example covers those 4 required areas I talked about in terms of when, the payment terms, the nature, and the obligation for returns, but it doesn't cover warranties. So now let's take a look at an example that would cover warranties. So here's an example that covers warranties. This disclosure is included under the commitments and contingencies footnote disclosure. So this example includes all the required information to be disclosed under the revenue recognition standard. Once again, I won't read this example, but these slides will be available to download from the BlumShapiro Revenue Recognition Resource website. So in closing, the disaggregation of revenue and contract with customers and performance obligations are the 3 required disclosure areas for private companies under the new revenue recognition standard. It's important for private companies to start to evaluate the impact that these disclosures will have on their business. So it's important that evaluation of the impact of the new standard starts now. To download today's presentation and for additional information and resources on the disclosures and the new revenue recognition standard, visit our BlumShapiro Revenue Recognition Resource website. If you have any questions, please contact one of our revenue recognition contacts listed above, which includes David Fonts, Chuck Adler, and Steve Treglia. Thank you, and have a good day.